Hamlin.
We just have a little music to get people pumped up here.
Okay. You're enjoying this. So you got a secret wish to be a DJ, don't you? Yeah. Like the head of the
like the Goldman
guy.
Okay.
Oh
so
yeah. Eye of the Tiger. I recognize it. Yeah.
Yeah. Exactly.
That's my
Just,
generation.
just wakes people up a little bit and gets them in the mood for for a mental workout. So, well, just allow me 30 seconds, Peter, to get this show on the road.
Sure.
Thank you so much. We are truly honored to have Professor Carr amongst us today. And welcome everybody to yet another cyber edition. I was hoping we would be live today, but unfortunately Delta is in town, and so we've we've decided to Delta hedge. And so we're back in hibernation for now. Just want to start by recognizing our volunteers. Hopefully you'll run into many of them: Isaac and Krishna, Gotham, Tony, and Yuan Hao. So guys, please jump on stage, say hello. This is a volunteer-run organization, so everybody knows. Most of them are students. Isaac's in the Carnegie Mellon program. So is Tony. We've got a couple from Rutgers, Yuan Hao and Krishna. So a lot of dedicated volunteers, and it's a good learning opportunity for all of them and for many of you. We are fortunate to have many of Peter's students today joining us, so thank you for that. Just a couple of bookkeeping items. Actually, maybe I'll let them say hello and introduce themselves. Some of them are on the job market, some will be soon. So for people who are looking for talent, here's some good guys. Isaac, our event coordinator.
Hey, how's it going, everyone?
Krishna.
Hey everyone, just as a reminder, you may have received a membership email before the event, or if you haven't, you'll receive it after. So please follow through with it, and I will be happy to answer any questions you have.
Tony? First event, right?
Yeah. Hi. Hello. Yeah. Hello, everyone. I'm Tony. I just graduated from Carnegie Mellon.
And you're starting at
Barclays. Yeah.
So, all right. Very good, Tony. Welcome, and hopefully we'll see you all shortly after with Professor Carr. Yuan Hao.
Hey guys, my name is Yuan Hao. You can call me Aaron, and I'm second year Rogers MQF students. Nice to meet you guys.
Okay, fantastic. So thanks everyone. Let's as we get ready for the talk, I just want to remind everyone, we try to keep these things free. If anybody's interested in sponsoring, please reach out to me later on. It is a nonprofit. We're just here to have fun and hopefully keep the content interesting and keep people coming back for that. So for the rest of this year, we've got a lot of really good speakers lined up. Of course, it's going to be hard to follow today's act, but we've got a lot of great people. Next one will be Mark Yusko on DeFi, Doug Martin on robust Fama French. That's, I guess, in October, and then November is going to be Petacombe on regime detection. And December, we haven't decided if we're going to have a speaker. We have somebody in mind, but normally we have a holiday party. This year, I'm not sure if that'll be possible, so we'll see. Hopefully we'll have booster shots by then. One of the nice things, by the way, with COVID, one of the only silver linings of this whole cyber mode is that we've attracted some new friends from and a bit of a following from other countries and cities. We now have a bit of a global footprint, not just New York. And that's a nice thing. I don't know if we have some people from far and wide. We usually get some from Canada and California.
Yeah, you have someone from a foreign country called California, I see.
Well, we've actually had a bunch of Europeans too, and last year we had a few European speakers, so it was nice to have quite a few from across the pond. It's usually a bit late for them if we start at 6, but In any case, so last time we heard from Austin Pollock of USC, who was setting the stage for tonight's talk on the Kelly criteria. And of course, we had Professor Carr earlier, about a year and a half ago. We're very fortunate and truly honored to have him back. He needs no introduction, really. I mean, any bona fide quant, of course, knows Peter in some capacity, if they've been fortunate enough to take his classes, or maybe you've run into him at Morgan Stanley at some point or at Bloomberg. He's got a far more distinguished bio than I could really go through with enumerating all the awards, so I will not do that. But suffice it to say that he chairs the FRE program at Tandon, and needless to say, under his leadership, that's kind of shot up to the top, and it's doing very well. So without further ado, Professor Carr, and let me, guys, what we're going to do is just switch off our cameras and mics, so we'll kind of fade away, and then Peter, I think you have to just sort of hit share at the bottom with the PDF.
Okay, I'm fine. All right, so see you later. Okay.
Okay, thanks, guys.
Okay. Okay, so let me try and get confirmation. Oh, darn. Okay. All right, great. Just take 1 sec. There it is. Okay, can someone confirm that they're seeing my slides?
Yes.
Yeah. Okay. Okay, thank you. Okay, great. So this is joint work with Umberto Cherubini. So he's a professor in Bologna, Italy. He cannot join us tonight. It's past midnight there. And this work started a couple years ago when he visited NYU Tandon, where I teach. And he's actually visiting again this fall in October and November to continue this work. So as you can see, the title of this talk is like long-term growth optimal portfolios, but it's also could be called Reconciling Kelly and Samuelson. So Kelly is a now well, I guess they're both now deceased. But anyway, Kelly was a physicist who worked at Bell Labs, and luckily enough, knew Claude Shannon when Claude Shannon first developed the concept called entropy that is, now extremely well known. And so Kelly, although he was a physicist, he realized that this notion called entropy could be applied to finance. And so he published a paper, and we'll see which paper he published and what it says in a moment. But basically, because let's say this approach to investment was rooted in information theory as opposed to economics, the paper attracted the ire of several well-known economists. Probably the foremost would be Paul Samuelson. And so let's say a controversy erupted as to what's the right way to invest. And I'll review that controversy and show a way to think about it. Okay, so we're interested in the long-term investment problem, and formally long-term will actually mean infinite horizon. And so basically there's a disagreement that I alluded to on how to think about this long-run investment problem. So, there's sort of a group of people, I'll give you their names in a minute, who subscribe to the sort of information theory approach that Kelly pioneered, which is based on the law of large numbers from probability theory. And then there's a counter group that's basically in business schools and economics departments, and they take a different tack on this problem, and they rely on a theory of investment that relies on maximizing expected value of something called a utility function. This utility function is pervasive if you've ever taken economics or business school finance courses. And so my background is I have a PhD in finance, and so I was exposed to utility functions a lot. And then I went to industry, and I remember hearing things, well, you cannot eat utility, and made a big impact on me, actually, because it's true. And so I basically avoid utility like the plague in my own research, to be honest. But you know, a lot of people use it. So we'll be seeing how you can use expect utility to think about long-term investment as well. Okay, so anyway, so just terminology. We'll come across this term called growth optimal portfolio. And although the two camps disagree on a lot of things, they at least agree on what the definition is of a growth optimal portfolio. And it's a portfolio that maximizes the log of wealth in the long run. So wealth in the future, including infinite time, is certainly thought of as random. But when you go out to infinite horizons, then the law of large numbers can actually remove randomness through averaging. And so that's why you're not seeing a word like expected value of or mean in this criterion. Okay, so obviously, you know, it's not just of academic interest to try and think about long-term investment. Many institutions kind of live forever, as far as we know. So, you know, pension funds have long horizons. Institutions in general are not people; they're actually corporations, and they don't die. So you know, it's reasonable to be worried about the long run when investing. And even if you are a person and you'll die if you're young, you can be worried about the next 40 years. And so even though that's mathematically distinct from infinite horizon, you know, perhaps the properties after 40 years are similar to an infinite horizon. So it's of interest. And basically, in economics, I was taught that you can distinguish theories as to whether they're normative or positive. So normative describes theories that are based on optimization. So it's about how people should behave. And whereas positive is actually theory that's based on what we observe. It's more sort of empirical. So the disagreement is basically between the two camps is on the normative side as to how investors should optimally behave. And so as I mentioned before, the economist camp, which includes finance people in business schools, are, you know, devoted to the idea that one should maximize expected utility for a finite horizon, and then maybe on infinite horizon, you don't need to say the word expected. But anyway, utility function is first and foremost the center stage in this business school and economics department approach. And, you know, this utility has a long history. I'll review some of it. You know, let's say it started with a solution to the so-called St. Petersburg paradox, and got a big boost in 1948 when John von Neumann and Oscar Morgenstern laid down a set of axioms that they thought it was reasonable for investors to describe investor behavior. And then they showed that if investors do satisfy these axioms in the way they behave, then it's a given that investors would always act as if they were maximizing the expected value of a utility function that's increasing and concave. So this is a theorem called the von Neumann-Morgenstern theorem. It has assumptions and it has a conclusion. Basically, the people in the economist camp often forget that there are assumptions, okay, and they just sort of remember the conclusion, and they say, you know, they're of the view that if they remember that there are assumptions, or the view that they're entirely reasonable and everybody should behave this way. But then, of course, it's not a universal agreement. There are, let's call it renegade economists, who look at the axioms of the von Neumann-Morgenstern expected utility theorem and say, well, wait a minute, you know, I can come up with examples where someone doesn't follow that axiom. So, you know, and so you can have this debate about how many angels there are on the head of a pin until you're blue in the face. And so that's why, let's say, a positive theory that's based on how investors actually behave becomes relevant. Anyway, back to the normative theory. The information theory approach got its start with, let's say, Shannon, who was just interested in describing information mathematically. He published a very influential paper called Mathematical Theory of Communication in 1948. And let's say Kelly afterwards applied it to the investment problem. So long story short, if you're applying information theory, the way an investor is supposed to behave is to maximize the log of long-run wealth. And so names that are associated with this point of view are Kelly himself, a guy named Leo Bremen, and a guy named Henry Latané. And anyway, there's kind of people after them who continued, let's say, promoting financial market research that does not emphasize utility functions. So people like Thomas Cover, who's an electrical engineer at Stanford, Farshid Jamshidian, who is a very interesting guy, used to work on Wall Street. Leuenberger, who was also at Stanford, proposed something called volatility pumping. You can read about it in his famous book called Investments. And a gentleman named Robert Fernholz, he's an algebraic geometer. He actually proposed something called portfolio generating functions. None of these ideas in this top slide here have anything to do with utility per se. I mean, you can sometimes shoehorn, you can say it's not inconsistent with utility, but none of these papers would even breathe the word utility function. Okay, so let me move on. So here's an outline of my talk. So first, I'll teach you what this Kelly criterion is. It's something you won't learn in a business school, but you would learn if you went to industry. It's actually often used as a way to manage money, not just in investment. It's also used when gambling, which you can argue is the same thing. And then we'll, let's say, compare the Kelly criterion to an approach based on utility. So then there's something called Fractional Kelly, which is advocated by the people who are information theorists who recognize that the original Kelly criterion may have, some improving to do. And so there's something called Fractional Kelly, which is a bit ad hoc, but addresses a deficiency in the original Kelly criterion, and that is commonly used as well. Then we're going to turn very theoretical and look at something called Kolmogorov averages, also called Kolmogorov means. So Kolmogorov was a very influential Russian probabilist, well, mathematician, really. I say probabilist because one of his greatest achievements was to put probability theory on a firm foundation mathematically. And so he did many things, and one of them was to come up with let's say, a generalization of what we mean by an average. So when in school, you're taught that an average is obtained by summing a bunch of numbers and then dividing by the number of numbers. But Kolmogorov said, well, let's take properties that calculation has, formalize them, like state what those properties are, and see if there are other calculations that also have those properties. And he showed that there are other calculations that also have those properties, such as a geometric mean, which you probably know means to multiply a bunch of numbers together and then take the nth root, where n is the number of observations. And then the last thing is I'm going to talk about so-called stochastic time change models. And these are very popular in the option pricing literature. And I've actually had done a fair bit of work in these time change models, and we're going to end up applying these stochastic time change models to Kelly betting. So as I mentioned, time change models are often used to come up with realistic descriptions of stochastic processes of underlyings of options. And but we're going to apply this approach to to describe returns and describe how people might invest, given that the returns are generated in this mathematical way. All right, so let's start at the beginning. So I want to talk about the St. Petersburg paradox. So St. Petersburg is a city in Russia, and this paradox goes back to, boy, wish I can give you a date, but it's like 17th century, I think. And so here's what it is. It's easy to state what this paradox is. We toss a fair coin, and the payoff is going to be 2 to the n, where n is a random positive integer that describes the first toss that results in a head. So the question is, how much should one pay to, get this non-negative payoff? And so if you just say the criterion for calculating how much you should pay is the real world mean, okay, so calculate the mean using the probabilities of 1/2 for heads and tails. Then when you do the calculation, Nicholas Bernoulli pointed out that the real world mean is actually infinite. So, to see that, you could realize pretty quickly that with probability 1/2, a head could come up on the first toss, in which case n would be 1, and the payoff would be 2 raised to the power 1 or 2. So there's a probability 1/2 that the head comes up in the first toss, and in that case, payoff's 2. And to calculate expected value, you multiply those probabilities of 1/2 with the payoff of 2. But you're not done. There's a probability of 1/4 that a head comes up on the second toss. That's from a tail-head combination. And so that's probably 1/4. And the payoff would be 2 raised to the power 2, so 4. And so you can keep going. And so as you keep, as you do this calculation, you realize that each summand is 1, and you're got an infinite number of summands, so the expected value is infinite. So, okay, so this is called a paradox because if you were to use as the criterion for how much to pay to play the mean, then the answer is infinity. And when you go look at how much people are actually willing to pay to play, it's never infinite, okay? First, no one has an infinite amount of money to pay anyway. But second, sometimes people are not even willing to pay $10, okay? And that's actually quite reasonable because, after all, it could be a 50% chance the payoff is simply 2. And if you paid 10, you actually lost 8. So, one basically, this problem, it makes you think that to figure out how to price, you shouldn't necessarily use the real world mean, okay? So Daniel Bernoulli, who is, I think, the brother of Nicholas Bernoulli, proposed a solution. He said that what really matters is not the money that you're getting as a payoff, which is 2 to the n, but how much happiness that money brings you. So he basically introduced the idea of a utility function way back in 1738, I think it was. And the particular utility function that Daniel Bernoulli suggested is log. So a utility function to an economist always is increasing and concave, and log meets those criteria. So log is a perfectly fine utility function for an economist and is the one that Daniel Bernoulli proposed. So if you do the calculation of the expected value of the happiness that the bet brings when happiness is measured by log, then you get a finite amount of happiness. And, but you can't eat happiness per se. Okay. So what you would actually do is what economists would say you should do to figure out the price is calculate the so-called certainty equivalent of this gamble. So you would find, you would actually take the, you would consider a certain amount that you're paying and take the log of that and equate the log of the certain amount to the mean of the log of the payoff and then solve for the certain amount. So in the end, you're doing exponential of expected value of log to get the price, but it's finite. Okay, so so now let's talk about Kelly criterion. And so Kelly imagined a situation where a gambler or investor is betting repeatedly over time, in discrete time, and over an infinite horizon. And there's the question that has to be answered is, what fraction of wealth, if you have any left, should you bet? The way it works is the bet is structured so that you gain or lose the fraction of wealth you bet, but the probabilities don't have to be 1/2. Okay, so in a Bernoulli situation where you're betting on, say, a coin flip, there's probabilities in it so that need not be 1/2. Okay, and so say that we indeed have a coin flip situation. So Bernoulli is the name of the random variable. These Bernoullis are everywhere, and the Kelly criterion is that you want to maximize the the calculation that's here on the left. So you're averaging over time when you're dividing by n, and what you're averaging is long run wealth, and because n is going to infinity. The log of long run wealth, and so Wn over W0 is the gross return, and then you're taking the log of it as part of the definition of the Kelly criterion. And so when you do so just when you have a Bernoulli calculation, law of large numbers is going to cause it to come to what's on the right there, where P is the probability of a win. So he's assuming, Kelly, is that whatever the probability of a win is the same as you repeatedly flip, and moreover that the flips are independent of each other, which is certainly reasonable. And so Q there is the probability of losing, and so you can see how he's coming to this calculation, which is the expected value of a Bernoulli random variable, and so P is the win probability, and Q, which is also in 0, 1, is the lose probability. So so let's say P is greater than Q, so you're more likely to win than lose. And so it's a favorable bet. And if you didn't have this particular criterion in mind, if you just said, you're just thinking, how should I bet when the odds are in my favor? I mean, you might naively say, well, I'm going to bet it all. Okay, I'm going to bet 100% of my wealth. And, the odds are in your favor, so why not maximize that way? So, Kelly realized that betting 100% is risky because, after all, even if the odds are in your favor, it could come out against you on the very first toss, and then you have 0. And then you're not allowed, you can't play anymore. So anyway, so if you use his criterion based on maximizing the long run mean of the log of wealth, mean over time, then you come to the optimal fraction F star of your wealth to invest as simply P minus Q. Okay, so Kelly, that's only if P exceeds Q. And if P is actually less than Q, so the bet is unfavorable, then Kelly says walk away. So if you go calculate if you follow Kelly's prescribed strategy, and you go calculate, what the mean long run log wealth will be, it's actually related to Shannon entropy, okay, which is being denoted by capital H here. And so that was the connection to Shannon. Okay, so and that's how information theory peaks in. Okay, so there were developments after Kelly. So Leo Bremen, a probabilist, showed that, not only this strategy provides the highest long run wealth over all strategies. So keyword there is long run. So economists will, they have to accept this math fact, but they'll say, well, maybe we don't actually care about infinite horizon. And Breman also showed that if you specify some positive threshold for wealth, like say $100 million, then if you follow the Kelly criterion, your the expected value of the first passage time to that level is earlier than any other strategy. Okay, and so that's when the odds are in your favor. Okay, there was some work by this guy Henry Latané, which I think I'll skip over, and just a very interesting work by John Long, who's a finance professor at Rochester, and so in option pricing, there's this fundamental theorem that says that if there's no arbitrage, there exists a so-called risk-neutral measure, which differs from a real-world measure, and you should price by taking expected value into risk-neutral measure. Roughly speaking, you actually need to discount at so-called risk-free rate as well. So later, after that theorem came out, people realized that there's other probability measures other than Q, which people always call this risk neutral measure. There's actually one for every numeraire. And then John Long realized that there's even a numeraire for which this so-called martingale measure is P, the real world probability measure. So it's an interesting result, but a bit off topic. Okay, so this slide is basically pointing out a quote from Kelly's 1959 paper that makes it clear, I'll read it to you, that Kelly knew about utility, but was not thinking about utility as the central focus. So what Kelly wrote is, the gambler introduced here follows an essentially different criterion from the classical gambler. So the classical gambler, he's referring to somebody who maximizes the mean, and as opposed to the mean of log. And Kelly said, at every bet, he, Kelly's gambler, maximizes the expected value of the log of capital. Okay. And the reason has nothing to do with the value function which is attached to his money. So that value function you can read as utility function, but merely with the fact that it is the logarithm which is additive in repeated bets and to which the law of large numbers applies. Okay, so the way Kelly's thinking is that he wants to apply law of large numbers, a result from probability theory that that works for arithmetic means, the usual means, okay, the means that you got taught in first grade or something like, I guess you had to learn how to divide, so maybe third grade, okay, where you simply sum a bunch of numbers and divide by their number. And so he's pointing out that finance is kind of naturally multiplicative. So his thinking is, you have $100 to invest, and maybe you earn 10% on the first period, so you get 110, and then maybe you earn 10% again over the second period, and since you invested 110, you'll actually have 121. Okay, so you're multiplying by 1.1 your wealth in a financial context. And so since he wants to use law of large numbers, which is an additive thing, he's going to take log to turn multiplication into addition. And so that was his motivation for using log, as he wrote here. Now, an economist can say, well, that's his motivation, but he can't get away from the fact that log is concave, and that this introduces the fact that you're maximizing over a finite horizon the mean of a concave function of wealth. That's, let's say, something that we economists are very familiar with, and there's no reason that the concave function needs to be log. So economists have a wide variety of concave functions that they feel describes utility. And let's say, in particular, power functions, such as the square root function, are increasing in concave and could be used as a log, instead of a log, okay, as a utility function. So what's happening here is, I would say, people not listening to each other. Okay, and basically, Kelly knew about von Neumann-Morgenstern. His paper even mentions those words, but basically thought no one really knows a utility function. But here's a criterion which is crystal clear. Maximize the mean of log of wealth, and you don't even have to worry about what your utility function is. So there's a guy named Harry Markowitz who won a Nobel Prize for his work on mean variance. And back in '59, which is when Kelly came out, wrote some things related to Kelly. And so basically, Markowitz thought that Kelly betting was consistent with mean variance theory. And in particular, is the log wealth maximizing portfolio is on the mean variance efficient frontier. So one you would consider. That turned out to be wrong. And so it goes to show that even Nobel Prize winners can make mistakes. And so this guy, Ed Thorpe, who just came out with a book a few years ago called Man of All Markets, came up with a counterexample. Okay. And here's what Markowitz wrote. I think I'm not going to go through this one. It's a bit convoluted the way he says it. And but the slides were made available, and if you're interested, you can follow up. So, but what it basically says is that Markowitz is in the camp of the economists that you shouldn't necessarily follow Kelly's criterion. Okay, so Samuelson was, a famous economist at MIT. He died at age 94 a few years ago. I actually had the honor of meeting him when I worked at Bloomberg, and wrote an article about him. So, so anyway, he basically wrote a scathing indictment of the Kelly criterion. He published it in Journal of Banking and Finance, and he actually wrote a paper that has only words with one syllable in the entire paper, except for the very last word, which is syllable, which is multisyllabic. And the paper was basically arguing against Kelly criterion. So, so he, to set this debate in context, I mean, Samuelson wrote in '71 that there's one and only one family of utility functions, which are written here, for which it's optimal to use the same repeated strategy. So, one of the properties of Kelly betting is that you're using the same strategy repeatedly over time. And, let's say Samuelson is saying, well, we economists know that if you have a log utility function, is the way Samuelson would say it, then you would use the same repeated strategy. But Samuelson would be the first to also say that if you have a power utility function, which is the one up here, then you would also follow the same repeated strategy over time. And these are the only utility functions for which the strategy is the same over time. So, log, although being what appears to be a different function than power, there's a way to write log as a limiting power function. And so you can think of log that way. So Samuelson wrote that Kelly's log wealth maximization is defective in that it attempts to replace the pair of the asymptotically sufficient parameters. So asymptotically means like long run. So the two parameters are mean of log of wealth and variance of log of wealth by the first of these alone, thereby gratuitously ruling out arbitrary gamma in the power utility family in favor of log. So, so Samuelson basically, I don't think he ever read Kelly, okay, because he's not addressing the point that Kelly's making about log merely being a device to turn multiplication into addition and not a utility function. And Samuelson's just saying, hey, the only thing you should ever do is maximize the mean of a utility function, and log isn't the only one you should consider. So Samuelson also worked on applications of the law of large numbers, as did Kelly. And Samuelson published a paper called The Fallacy of the Law of Large Numbers. Now, this fallacy paper is not actually critiquing Kelly. It's critiquing a common misuse of the law of large numbers. So let's say you offer a bet to someone that can only be done once, and you ask them, should they take it? And sometimes people will say, no, not if I can only do it once, but I would do it if I could do it repeatedly over time. Sometimes people say that. And Samuelson tried to argue that that kind of thinking, to reject a bet if offered once, but taking it if it's offered repeatedly over time, Samuelson called that a fallacy. Okay, so a mistake in how you think. And he proved a theorem that says, first, he's using utility theory, which again, not everybody's convinced is the only way to go, but he is clearly. And he's saying if a utility function rejects a lottery or gamble for all wealth levels, okay, that's a key part of the theorem. That's, so what it means is we're not asking the question, will you take it once at your current wealth? We're actually asking the question, will you take it once at all wealth levels you could possibly ever have? And if you say, no matter what my wealth, I'm going to not take it once, okay, then Samuelson can show that you should reject if offered n times, where n need not be infinite, just as any positive integer. And he's assuming that, which is reasonable, that the repeated gamble is payoffs or IID. So that's the theorem Samuelson published in 1963. And, it was sort of meant to say that you shouldn't think that law of large numbers is going to sort of turn a lemon into an orange or an apple. Okay, so there's a proof which we'll skip. And okay, so Steve Ross, who's was a hugely important financial economist in the 20th century and even the 21st, he published a theorem related to what Samuelson did. And so Ross said, well, what utility functions would actually reject the same gamble at all wealth levels? Okay, so that was like just a hypothesis in Samuelson's theorem. And Ross is going deeper and saying, so what utility functions actually have this property? And so there's only two, the so-called risk-neutral utility function, which is linear utility, and also the exponential utility function, which is got so-called constant coefficient of absolute risk aversion. So anyway, so basically what Ross is saying is Samuelson's theorem is not that important because nobody thinks that investors have linear utility. And then the exponential utility function, yeah, that's a little more reasonable than linear because it's consistent with risk aversion as opposed to risk neutrality. But it's still very particular and precise. And, let's say probably investors aren't going to display a constant coefficient of absolute risk aversion. So that's how I read Ross's result. In the interest of time, I think I'll skip this. And so obviously Samuelson had problems with Kelly's criterion, and he's not the only one. I mean, so besides other economists and other business school professors like Samuelson's student Merton, for example, there's actually people who subscribe to information theory as the important mathematical tool for investment, but still have doubts about the Kelly criterion. And the issue is that the Kelly criterion, being based on law of large numbers, only holds perfectly in the infinite long run. And, if you're thinking about how shall I invest before I retire, then given that you're not going to live forever, you should be worried about finite horizon. And it does turn out that Kelly's strategy is an aggressive one. So meaning that although it's great over infinite horizon, if you actually have a finite horizon, you're betting very aggressively. And if we just restrict ourselves to strategies that would be followed by investors with so-called constant relative risk aversion, then log has constant relative risk aversion, and it's an aggressive member of that family. So being pragmatic people with finite horizons, they say, okay, we'll deviate from Kelly as described in this fractional Kelly slide. So you have money to invest, and what you'll do is invest a proper fraction of it using Kelly betting and have the other fraction just in a risk-free asset. So, this is kind of similar to portfolio insurance, where you create a floor with the risk-free asset and then engage in dynamic trading strategy with the so-called cushion. And so then the fraction you invest in a setting with the usual log normal prices in the future is here, mu minus r divided by 1 minus gamma sigma squared. So if you were maximizing the log of wealth in this classical log normal setting, the fraction bet would be mu minus r over sigma squared. So you'd be setting gamma to 0. So by setting gamma to some number above 0, you're changing the strategy. Okay. So this finance professor out in Boulder, Colorado, also, let's say, worked on using information theory for investment, but not necessarily doing Kelly. I think I'll skip that. Okay, so now we come to the more mathematical part of the talk. And this is actually where my work with Umberto begins. So up till now, let's say I've been reviewing the literature. And so this result, which is a mathematical result from the 20th century, which by mathematical standards means it's recent, is an important part of what Umberto and I are doing. So let me go through it. So Kolmogorov, the Russian probabilist, asked, what do we mean by average? Okay, so he laid out 4 axioms that an average should satisfy. And if you agree that these axioms do describe an average, then he tells you, how to calculate an average, which is on the next slide. So, okay, so say you've got n numbers, x1 through xn, where n is at least 2, and you want to sort of summarize them into a single number, which is by using a function g. And, you can ask, under what conditions will this function g be what most people would describe as some kind of average? Okay, so, so g cannot be just anything. I mean, so for example, if all the numbers were positive and g was minus infinity as the map, that would clearly not be an average of a bunch of positive numbers. Okay, so Kolmogorov demanded that g be continuous in each argument and monotone in each variable of the n variables. That the second point, that they're exchangeable. So what it means is if you sort of do permutations, let's say switch x1 and x2, that you don't change the average. Okay, so he's basically saying the order in which you encounter the numbers to be averaged does not matter. Okay, and okay, then he also said as property 3 that if by some miracle all n numbers happen to be the same number, then the the average of those common numbers should be that common number. Okay, so that seems reasonable. If I had to average, 1 and 1, I would say the average is 1. Okay, and okay, then finally, and this is kind of hard to read, this last one. So let me just try and describe it in words. He's basically saying that if you were to take any subset of the numbers and replace that subset of the numbers with their general average, that the global average is the same. So it's like you want to be able to average over numbers which are themselves averages. And okay, so then anyway, that last one I'll let you think about. But the punchline is that if you subscribe to those 4 axioms, then Kolmogorov can tell you how to compute an average meeting those 4 axioms. And so the calculation is on this slide. So basically the calculation involves a function psi of x that is continuous and strictly monotone. So strictly monotone means increasing or decreasing. And the way the function is involved is written here, but let's say that's a lot to digest. So let me try and put it in words. So you have a bunch of numbers, x1 through xn, and you want to average them. So how are you going to average them? So what Kolmogorov is saying is you apply the same map, which is psi inverse, to each of the n numbers. So you go to some different space, let's say, and let me do a concrete example. So the concrete example would be the map psi inverse is the exponential. Then anyway, you're in some new space, and then you do an ordinary average. That's what's in of the new numbers. So you add and divide by n, and then you come back. Okay, so if psi inverse was exponential, psi would be log. So that right-hand side in the example I gave would be called a log sum exponential. And I've actually been doing a lot of work. Well, I've been doing a lot of work on that. Okay, in the context of option pricing. So anyway, so that's what a let's say generalized average looks like. Sometimes that's what this is called, a generalized average. So examples of generalized averages you may have come across would include geometric means, also harmonic means. So for a harmonic mean, you require all the x's to be positive, and then the psi inverse function is the reciprocal, so 1 over, and then that function, if psi inverse is 1 over, then psi turns out to be 1 over as well, so it's self-inverse, and so that's a harmonic mean calculation. Okay, so an example of let's say of people playing with arithmetic, because that's kind of what we're doing with the Kolmogorov calculation, is playing with the arithmetic. You can actually say that, like, so is it, for example, when you go from a arithmetic mean to a geometric mean, you're playing with the arithmetic in that you're switching addition to multiplication. And there are more arithmetics than just addition and multiplication. And so one can, and as a result, one can design like exponential functions and log functions that differ from the ones you were taught in high school. So this guy, Salas, who's a physicist in the 20th century, so fairly recently, invented something called Q-calculus that he invented in the context of thermodynamics. So it turns out that, let's say, Boltzmann pioneered thermodynamics in the 19th century and proposed something called entropy then, and Shannon in the 20th century kind of reapplied the same formula in the information theory context. And so back in thermodynamics, there's the standard entropy of Boltzmann is said to be extensive, but physicists wanted to kind of play around with different notions of entropy that are not necessarily extensive. And so this Salas entropy is an example of a non-extensive entropy that people in thermodynamics and statistical mechanics use. So anyway, mathematically, you basically do the same things you're used to in computing entropies, but you work with non-standard exponentials and logs. Okay, so what would now be called the Salas log is defined down below, and it has natural log as a limit, but it's thought of as applying before the limit. Okay, and so you can, in finance, we compound all the time. So we multiply up gross returns, but since there are other binary operations that mathematicians have introduced and physicists have introduced, we can use those instead. So like when you go back to my example where you had $100, you earned 10% on it, and you left it all there to play one more round. You don't have to do that. Okay, you can take your $110 and let's say put $5 of it in a riskless asset, and then bet 105 on the same strategy. Okay, on the same thing. Okay, so you don't have to do what finance people call self-financing. I mean, with just one asset, you can be self-financing with two assets or more. So there's all kinds of possibilities for investment strategies. And some of them we can even interpret as compounding, but not the classical multiplying up. So if you're using, let's call it Salas compounding, then you're basically going to, the criterion would be to maximize the Salas log of wealth in the long run. And that turns out to be an average, but not the average that Kelly thought about. So it's a generalized Kelly average. And and then I know this looks weird, but if you just use Salas logs, then if you translate what does it mean using the arithmetic I'm familiar with, it's actually maximizing a power function of wealth, which Samuelson definitely advocated. So this is where we're starting to reconcile Kelly and Samuelson. We're basically saying, hey, guys, there's more arithmetics than the one you were taught in third grade. And if you just open your mind to the possibility of other arithmetics, then you guys are actually doing the same thing. Okay, so if Kelly would say, hey, there are other logs besides natural log, like the one Salas invented later, then the Kelly criterion using that Salas log would end up maximizing a power function, which Samuelson would be very happy about. So so you can wonder, is this just math, or is there any difference between Kelly betting based on natural log, the usual one, versus this alternative rule based on Salas logs? And this graph is meant to say, yes, there are differences. And so here we're simulating following Kelly when the proper thing is to do generalized Kelly. And let me skip that. Okay, so now we come to the real work that Umberto and I are doing. And there's only 11 more slides, so we're getting close to the end. So basically, we're wondering, okay, so we know about mathematically there are other kinds of compounding besides just doing ordinary multiplication, but it seems a bit artificial to rely on these other binary operations. I mean, can we actually derive these alternative binary operations from considerations that are economically motivated? So the short answer will be yes. And so it turns out that let's say we start by considering the mathematical object called a moment generating function. So Z here is a random variable, and S is called the parameter, the moment generating function. And we're asking, is there a financial interpretation of a moment generating function? And the short answer is yes, if you think of Z as a random length of time. So, and then we would interpret the moment generating function as the gross return over that, the mean gross return over that length of time. And so let's say in finance, without thinking about it, when we're thinking multi-period, we tend to think in terms of several periods, all of deterministic and usually the same length, but nothing, you know, if you're good in probability, you might say, well, why can't I consider multiple periods, each of random length, and as a first cut IID, and, you know, think about the world that way. So, okay, so that's how we're going to think. So, and we are far from the first people to consider what's called random time change or stochastic time change. So it goes back to this guy Clark in 1973. So 1973 was a very good year for finance papers. Besides the Clark time change paper, the Black-Scholes and Merton papers came out in 73. And as it happens, my email address is pc73@nyu.edu. So I seem to be lucky when it comes to email addresses. So anyway, Clark said, hey, why don't we think of, let's say, returns as not happening in calendar time per se, but happening in cumulative volume. So, you know, he's thinking of a stock market where there's a bunch of stocks trading. Let's just pick one, say Tesla. And at the beginning of the day, you know, maybe there's a share order for 100, and then there's a 300 share order, and then a 10,000 share order. We can keep track of the cumulative volume, which just only goes up. And, you know, so to a mathematician, a clock is just anything that increases. It doesn't have to increase deterministically, and it doesn't have to, let's say, have it, doesn't have to be something that is measured by a watch. And so Clark basically said, well, what if, let's say, prices are random, not in time, but in volume? Okay, and then volume is itself a random function of time. So, so that's a common way of thinking. You compose maps. And so N.A. and Gaman is a frequent co-author of mine, proposed that a stochastic clock be measured by order flow, which is similar to volume. And others use like realized volatility. So quadratic variation be a better word there, which is an increasing process. So there's lots of work on stochastic time change motivated economically. And so there's also, you know, work in the field of stochastic processes. So classical work in stochastic processes by Dambus, Dubas, and Schwartz says, for example, that every continuous martingale can be represented as a stochastically time change standard Brownian motion. This guy Monroe said every semi-martingale can be represented as a stochastically time change Brownian motion, so even bigger family. And so I did this work on time changing so-called Levy processes. So Levy processes were mentioned by Austin Pollock last time this was held. So they are continuous time stochastic processes that are, let's say, the continuous time analog of having IID. And Paul Levy basically characterized them all. And so examples of Levy processes that are widely used in practice would be Brownian motion, let's say Poisson processes, gamma processes. And they're all, let's call it homogeneous. So they're time homogeneous and space homogeneous. And so I did this work with Lauren Wu, another frequent co-author, where we didn't like the time homogeneity that Levy processes have. So we did a stochastic time change, which introduces, let's say, stochastic time inhomogeneity. And we showed that that is a good idea to capture what's going on in markets. So there's people who went beyond my work with Lurin. So you could time change a Markov process, which is more general than Levy process, for example. You can time change non-Markov processes too. And so there's a general theory that people have investigated. And then there's specific examples of particular time changes that people have used. And these are listed here. And we're going to be using a couple of them, Umberto and I. So I'll just focus on the ones that Umberto and I use. So there's a process called variance gamma that was proposed initially by Medan and Sinetta in 1990. And that process is Brownian motion running on a gamma clock. So the gamma clock's independent of the Brownian motion. And if it's like standard Brownian motion running on a gamma clock, it has the flaw that the resulting distributions are symmetric. And then we look at data, there's skewness. So in some follow-up work with me, we introduced asymmetry in 1998. So, and actually now people, when they say VG, they mean the asymmetric model. So after that, I got involved with three other co-authors, especially Mark Yor, who's a brilliant probabilist, and we invented a model that's a generalization of variance gamma, which we named, which had 4 parameters, and we named the parameters after ourselves. So this model became fairly popular in certain circles, but we're not going to use it, Umberto and I. The one we are going to use is this one at the bottom called normal inverse Gaussian, which everyone abbreviates to NIG. And so there, you're running a Brownian motion on a different clock than the gamma clock that Medan, Carr, and Chang use. And the clock you run it on is called inverse Gaussian. Okay, so we're going to work in discrete time, actually, Umberto and I. It makes it easier, but all that work I just referenced is continuous time. And so we have a bunch of IID random variables called Z, and you can think of those, they're all positive, so you can think of them as, time spans, okay? Like one way of thinking about it is, you go buy a Rolex watch for $5 on the street outside France's Tavern from a shady dealer, and you say, wow, boy, a Rolex for $5, that's great. Let me see how well it keeps time. So there happens to be a very accurate clock nearby, and you see 1 minute of time go by on the accurate clock, and you see what happened on your shaky clock, and it turned out it was 2 minutes on the shaky clock. And then you let another minute go by on the good clock, and you see how much time is measured on the shaky clock, and it's 30 seconds. And so, so we can be adding up the minutes on the good clock, and we'd be at 2 minutes, and we can be adding up the calculations from the shady clock, and I forgot what they were, but you'll get an increasing random process. And so that increasing random process is what we're calling X here. So X at any time n is not random, is a random variable, and has a moment generating function. So because the increments are independent and identically distributed, the moment generating function of X at time n is just the moment generating function of X at time 1 raised to the nth power. And so now we do a calculation thinking that the way that prices evolve and things we're betting on is something, let's say, regular running on a random increasing clock. And but the clock has some regularity too, in that at least the laws of the random time increments are the same. So if you go calculate, this expectation of the exponential, which is financially being thought of as your wealth when you're in that world, you end up doing a Kolmogorov mean. So the Kolmogorov mean, if you recall, is this calculation at the bottom right, and just requires that psi be an continuous and monotonic function. And in this particular application, psi is the moment generating function of x1, which is z1. Okay, so so anyway, so the so that's how we're essentially calculating returns, is running the processes that Samuelson and Kelly worked with on a random clock. And if we pick gamma as the Levy process that describes the clock, then it turns out that the psi function that's used to calculate the Kolmogorov mean is that. And it turns out that if you now describe how investors behave, you end up maximizing a power of wealth. So we're having them basically follow Kelly strategy, but not in Kelly's world. And so as a result, this is what happens as opposed to the log. And so you end up again reconciling with Samuelson if if you just randomize the clock. So you can randomize the clock differently. You could have an inverse Gaussian process instead of a gamma process describe the clock. So inverse Gaussian is called that because it describes the distribution of first passage time of a Brownian motion to a level. You keep sort of moving up the spatial level and keep looking at the sequence of first passage times to this ever increasing level. So that's called an inverse Gaussian process. And then you can run an independent Brownian motion on it, and then you get what's called normal inverse Gaussian. So when you go compute the moment generating function in this world, the psi function that we're using to average is given in equation 4. And then when you go look at what someone who's doing Kelly betting in this stochastic the time change world ends up doing, they actually end up doing mean variance. So so remember Samuelson's point that his critique of the original Kelly is that it focuses only on the mean of the log of wealth, and really should be focusing on the mean and the variance of the log of wealth. Well, here we're doing exactly what Samuelson wanted you to do. So this, so the punchline is that, everybody back in the 50s and 60s was working with highly stylized models, okay, which, could never describe actual markets. And, got into a rancorous debate about their highly stylized models. And, amazingly, you get more realistic models that are based on random time changes. And you can kind of say everybody's right. Okay, so let me wrap up by saying that if under our approach, returns are generated by running a time homogeneous stochastic process on an increasing Levy process, such as gamma or inverse Gaussian to get VG or normal inverse Gaussian, then the compounding need not be geometric, which is a perfectly reasonable strategy, but you still would follow Kelly criterion and maximize the average growth. It's just that it's not the arithmetic average, and it's a Kolmogorov average. So you would deviate from Kelly, and you could easily deviate if you're using say variance gamma setup. You deviate in the way that people recommended you do it. So you end up as if you had a power utility, and that's also fractional Kelly. So it's like there was practically speaking, the actual investment strategies that were finally advocated as workable are actually the ones that are optimal in our world. Okay. So of course, if you've ever taken a finance class, you know that finance professors advocate using mean variance to figure out how to invest. And that's also something that can come out of our analysis. Okay, so I'm done. So I'm going to wrap up here, and if I can, and try to make my way back to where you guys are. So so I'll try and stop sharing. Okay, and there we are. Okay, so I see Malind, and thanks for hanging around. Oh, there's even as many icons as we had at the beginning. I'm surprised. Okay, I thought I would have put people to sleep. Maybe they are asleep, but anyway, they didn't leave. So that's progress.
No, I think you've got a very engaged audience. I mean, I certainly learned a lot more about Kelly today than I have on previous iterations. So
Okay.
Thank you for the very nice review of the literature. That was actually very useful to just understand the debate between the normative and the positive schools of thought and on this particular matter of, I mean, certainly many of us have dealt with utility functions, and at least those of us in the industry may be happy to have forgotten about them.
Yeah.
Sure. But it's nice how you tied it back to CRR and all that, and sort of, log utility, of course, special case of that. So I wasn't completely clued into this debate and Samuelson dissing Kelly. So I'd always wondered what the different schools of thought were. Why do people in finance never talk about Kelly? Sort of.
Yeah, right. Yeah, because there's papers called like fallacy of Kelly betting. But, the interesting thing is that, I mean, Kelly betting is just a special case of what finance professors advocate. So, so they're in a tricky situation. They say, well, you can be more general. And then you say, okay, fine, I'll be more general. What utility function should I use? And they say, use yours. Say, well, I don't know mine. Why don't I use yours? What's yours? And then the finance professor says, well, I don't know mine. But you should use a utility function. I don't know. So it's, at least Kelly has got, he doesn't, make you ponder your degree of risk aversion. Okay. It's very concrete, mind you, it turns out to be a fairly aggressive, so you're not very risk averse if you're doing Kelly betting. And if you, at your current wealth level, are relying on the long run, it'll pay off in the long run. Okay. So that Samuelson critique about if you reject a bet once, you should reject it always is actually not applicable, because he was demanding that you reject the bet not just at your current wealth level, but at all wealth levels. Okay, and I mean, you could easily imagine that when Bill Gates was young, before he started Microsoft, he was rejecting a bet at that wealth level that he's now taking at his current wealth level, right? So, Samuelson's hypothesis that rejecting the bet at all wealth levels is quite strong, right?
Do you think maybe Elon Musk would be a Kelly better?
Yes, I mean, so yeah, I do think he, does look at the long run. Actually, it's interesting you bring up Elon Musk. So, he's kind of a first principles guy. So, if you ever heard him talk about how he thinks, he'll say that it's very important to think exactly the way physicists do, like Salas and Boltzmann and like that if you're trying to understand complicated systems, you need to establish first principles like entropy is increasing, things like that, but to make any progress. And so, I wish I could be more specific as to how Elon Musk specifically comes up with principles. But anyway, he's clearly of the school that you kind of derive optimal behavior from first principles, not make it up as you go along. And so far, he's backed up his thoughts.
Yeah. I mean, the review, at least from my naive standpoint, was very helpful. My guess is we probably lost a few people once you got into the, into the thick of the compounding with stochastic clocks and some of the more technical stuff. But maybe if we can just backtrack to, I think people probably have some intuition till about slide 25, where you're showing what happens if one bets the standard Kelly. So maybe if we just jump back to some.
Oh, you want me to share screen? Should I reopen the presentation?
Let me see. I have it open if you want. I can share it, or you can share it.
Okay. Let me do it. I'm experienced at this point. Okay.
So I'm just wondering if you could go back there and give us a little more, just putting aside all the stochastic clock stuff, which is very difficult for many to follow, but just the simple intuition.
Slide 25. Okay, going back to
we're on like page 25.
Okay, just a second. Oh, here. Okay, 25.
Oh, okay. Yes.
Okay,
there.
I'll tell you what's going on in this slide.
Yeah. So I'm just trying to come back to putting aside all the time change stuff, right? Like if you were just in the Kelly world, it's too aggressive. You're supposed to bet P minus Q. Where does that lead us? At a practical level, let's suppose, somebody's investing on fractional Kelly.
Right. Okay. So so here this particular graph is about a different strategy than Kelly betting, but close to Kelly betting. So it's using an unusual compounding. So we're not merely multiplying gross returns. So remember I said like 100 turns into 110, but you could put 5 aside and then, invest 105. And so basically that kind of thing is what's going on here. And so you're, and the original Kelly, you only bet when the odds are in your favor. So the probability of success is above 0.5. And we're considering here that the odds are in your favor when the probability of success is 0.6 or 0.7 or 0.8 or 0.9. And what we're doing is we're saying that if you just, without motivation, the motivation came later with the time change that you don't want me to go through, but without motivation, did this kind of compounding, then you compare to how somebody doing Kelly would perform. I have to go back to the paper to know what's on the scales, but unfortunately it's not labeled. So anyway, so that
actually, if you don't mind, let's go back even further to page 18. So I'm just trying to make sure that the audience, or maybe it's because I'm very slow, but let's just go back to page 18, right?
Yeah.
So,
okay.
18, you mentioned that the fractional Kelly leads the same strategy as CRR.
Yeah, constant relative risk aversion, as opposed to Cox-Ross-Rubinstein. Okay, yeah. Okay, right?
Right, as opposed to Cox-Ross-Rubinstein. So this looks a little bit like the Sharpe ratio.
Yes, I grant that. So let me address that one. So it's not okay, it looks like it, I agree, but it's not the Sharpe ratio. So the Sharpe ratio, as you know, is mu minus r over sigma.
Yeah.
So there's two important differences. So first, we're divided by sigma squared, not sigma.
Yeah.
And then also, if gamma is not 0, there's a 1 minus gamma in the denominator. And so let me address them one by one. So when you look at mu minus r over sigma squared, that's not a Sharpe ratio because it's sigma squared. And actually, people have called that Merton ratio. And let's say the reason people would look at the ratio of expected excess return to variance as opposed to standard deviation is because of a different invariance that holds for this Merton ratio than the one you're used to for the Sharpe ratio. So let's say for the Sharpe ratio, it's well known that you cannot change the Sharpe ratio by employing leverage. Okay, when you lever, you don't change the Sharpe ratio. So it's like people can't sort of cheat through levering with the Sharpe ratio. So in the Merton ratio, it will change when you lever. Okay, so it doesn't have that invariance. But it has a different invariance, which is over time. So the point of the Merton ratio is that you don't have to consider one particular time horizon, say a year. You can sort of simultaneously consider all possible time horizons. And you would actually engage in the same strategy regardless of your time horizon. If you follow Merton's approach, and like Merton looked at, if you have in general power utility and you're engaged in continuous time investment problems, you know, how should you invest when you have just a risky asset and a riskless asset? And if gamma is the parameter in your power utility function that describes your degree of risk aversion, Merton showed that the optimal amount to invest in the risky asset is given by this fraction here. So, you know, so it's intuitive in that the bigger is mu minus r, which is the expected excess return of the risky asset, the more you'll invest. The bigger is the variance of the risky asset, the less you'll invest. And the more risk averse you are, the less you'll invest. Okay. So anyway, so this is, you know, this non-Sharpe ratio is Merton's fraction on how to invest in continuous time setting when you have one risky asset following geometric random motion and one riskless asset earning a constant interest rate, little r. Okay.
Okay. Wow, that's very interesting. We were learning about the Merton ratio now. That's pretty cool.
Yeah.
So this
So the reason you don't know it is because unlike Merton's other work on derivatives pricing, this work has had almost no influence in practice. Okay, as you know. Okay, so every academic knows this work of Merton's. This is like a business school staple. It's probably taught in some MBA classes, but it's not used. So why is it not used? I'll give you a very simple answer. No one knows gamma. Okay, so you know, as part of Merton's thinking, you have to specify the power gamma in your power utility function, and you don't know it. Okay, so it's just, you know, the guy was brilliant, but, you know, he had hits and misses, and his hits were like derivatives pricing. That was huge. He invented delta hedging, for example. You know, he was the first to publish on it anyway, but I would call this a miss. You know,
okay. But the same criticism would apply to all of utility theory.
Yes, it would.
CRR, because nobody knows gamma in general.
I completely agree. You know, you can look up a paper called "The Futility of Utility," which, you know, makes the point I've been making, and you know, so like, you know, it's an idea utility that's had its day in the sun and, you know, failed and should just be forgotten about, I think. Like, so, and I realize I bored you with a lot of utility theory there, but I mean, I kind of had to really fully describe the debate. And
no, it's very interesting to me personally, because years ago I had tried to do, you know, maybe about 15 years ago, you may remember, it was trendy to sort of modify the Sharpe ratio and try to fix the Sharpe ratio at higher moments and adjust for that, actually.
Yeah, that's fine.
So I tried this type of certainty equivalent approach using CRR to do that. But in any case, let me open it up to see if we've got more questions coming in from the students and other folks. We have somebody saying fractional Kelly depends on units.
Okay, very observant. So let me talk about the units here. So let's start with R. It's the risk-free interest rate. So that's in 1 over years. Okay. So, 10% per year is in 1 over years. Okay. And so obviously, if we're subtracting R from something, that something has the same units. So mu has units 1 over years as well. Okay. Okay. Now let's talk about sigma squared. So that's called the variance rate of, let's say, of a geometric, I would call it of the log of a geometric Brownian motion. And so that's got units 1 over years as well. Okay, so it's got sigma squared is the same units as the numerator. So therefore, the fraction mu minus r over sigma squared, that's dimensionless. And okay, so now we come to gamma. So gamma is dimensionless too. Okay, and so that means the whole thing is dimensionless. And what the calculation is trying to describe is the fraction of your wealth that you want to invest in the risky asset when the alternative is the riskless asset. Okay, so it's an imagined world where there's only 2 assets. One risky, think of it as the market portfolio, and one riskless, think of it as a money market account. And so anyway, so if this evaluates to say 0.6 dimensionlessly, then you should put 60% of your wealth in the risky asset and 40% of your wealth in the riskless. Okay, so that's a dimensional analysis.
That makes sense.
But I'm impressed that the person who asked the question, went to the trouble of thinking about dimensions. That's a very mature thought process, and whoever did it should be congratulated for thinking that way. So I do it all the time.
If we can
personally.
get them on stage. I try to get people more participation if I can figure out Mirabelli.
Yeah.
Mirabelli. Let me see if I can get him on stage. If he wants to broadcast, yes. Okay. If you'd like to join us, I think I made you a speaker. You just have to turn your camera or mic on. I'm assuming it's Andre.
Right. Hi. Can you hear me?
Yes, I hear you.
I just didn't get if the Sharpe ratio is unitless. I don't get how you're telling me that the fractional Kelly is also unitless.
I never said the Sharpe ratio is unitless.
Well, standard deviation has the same units as the thing it's standard deviation of. So
true.
If mu and sigma both have the same units, then mu and sigma squared don't. And mu over sigma squared don't. So
yeah,
I didn't follow what you said before.
Okay. Probably, okay, so I think that the reason we're disconnecting is you're thinking in single period and I'm thinking in continuous time. So so I agree with your statement that a standard deviation is the same units as the random variable. That's true. And so you're thinking in discrete time, you're looking at a return. For you, the return has units 1 over years. And mu, r, and sigma all have units 1 over years. And then you're going to say, therefore, sigma squared does not have units 1 over years, but 1 over years squared, right? That would be the calculation. And you would be right in the single period context. So, I didn't say it and I should have. This is in a continuous time setting. So if you know Brownian motion, then you know that it's variance that grows linearly with time, not standard deviation. And so the variance rate, which is what the sigma squared is in 1 over years in continuous time models. Okay.
Okay.
So you were right, first of all, in discrete time. Okay. And what the thinking is of this slide is that you're working in continuous time, which means that you're constantly rebalancing. Okay, so every instant you're changing the number of shares held so as to keep a fixed mix, as opposed to, say, doing it annually. Is that clear?
Yeah,
Okay.
I see. It's continuous rather than discrete. I got
Yeah, in time. Right. Okay. All right, but thanks. Yeah, that was a very good point you made.
Okay. I'd love to get some other people up here, and Andre, you can just turn off your camera and mic if you want to fade out. Let me just look at the chat box here, see if we've got anything else going on. Carlos just sends his regards and thanks. Okay. Would the slides be available? Yes, of course. He's been kind enough to let us post it.
Oh, and I'll just comment. There's a paper on the web. Just like look for Carr, Cherubini, Kelly, Samuelson. You'll find it. Okay.
Is it on SSRN or?
Yes.
Okay. All right, folks. We've got a lot of students in the audience, I know, so somebody must have a better question. Another question, at least. Oh, Gautam Wahi, please jump on. Gautam's one of our all-time volunteers.
Hey, Milind. Hi, Professor Carr. Thank you so much for this. This is very informative. I just had a question on like the initial slides of Kelly betting. So you'd mentioned that Kelly betting is great over like an infinite time horizon.
Mm-hmm.
Over shorter horizons, it's not as good. You'd also mentioned that for a given certain target wealth level,
Mm-hmm.
Which I assume would happen over a finite time horizon, Kelly betting kind of reaches that target level much faster than any other strategy.
I'll go back to that, but yes, that's true. So let me bring that up. That was Bremen, I think.
So assuming that it does come like it.
Here it is.
Yeah.
Okay.
So like if it does reach like the Kelly betting mechanism does reach a target wealth level faster than any other strategy, wouldn't that occur during like a finite time horizon? Observe that.
So in expectation, yes. And I suppose all realizations would except with probability 0 would have to be finite too. So yes. so that's a good point. So the so you can, let's say I hear you that this is a finite horizon, albeit random horizon, which I have no problem with, result, and which supports Kelly betting. You're absolutely right. So when I said it doesn't work so well, I wasn't thinking about this. I was thinking the way most finance professors think, that your horizon is 5 years as opposed to hitting a target, and and then you can lose a lot of money with a fixed finite horizon if you do Kelly. Okay. So, but that's a very nice point you made. Thank you for emphasizing that this is also finite horizon. It's just that it's random, and this kind of strategy where we'll follow Kelly until we reach a barrier, and then we'll retire, like we'll liquidate our holdings in the risky asset and just have cash. Is certainly something we all aspire to, and Kelly can help us get there quicker. Yeah.
Got it. So is it safe to say that the infinite time horizon that we speak of in Kelly betting is actually just how it's defined in like law of large numbers, that where n tends to infinity. So any large time horizon tends to yield better results with Kelly betting, and like
that's a good question. I mean, that's a good question. I mean, I know a paper that would probably address it. Like the good news about this Kelly thing is it's really old and there's a lot of papers on it. So there's a fantastic survey about the growth optimal portfolio, which is synonymous with Kelly betting, that you can find very easily, I think. And it goes through all the mathematical results. So what you're asking now is there monotonicity in N, the number of, bets? And so I don't know the answer off the top of my head. My guess is yes, though. So, it just keeps getting better and better the longer horizon is my guess, but I don't actually know that.
Well,
Thank you. This was great.
Well, you've got this Mike Stutzer's large deviations approach, which seems somewhat related to this.
Yeah. So that would, large deviations is a mathematical theory that was invented kind of at NYU Courant, actually, by anyway, and it's trying to describe tails, okay, extreme tails, and how fast like probabilities go down to zero, probability densities go down to zero. Okay, I'm looking for it. Here we are. So yeah, so it's Varadhan was the name I was trying to think of. He's an NYU professor at Courant, and he did this important work on large deviations and connected it to relative entropy maximization. So relative entropy is a cousin of Shannon entropy, let's say. It's called Kullback-Leibler divergence. Mm-hmm. And basically, Shannon was proposed his entropy measure as a measure of like the width of a distribution. And Kullback-Leibler came later. They were interested in, sort of roughly speaking, the distance between two probability distributions, roughly speaking. And so you, in order to use relative entropy, you would need to provide a pair of probability distributions. And there's a typo there, actually. It should be constrained. Okay. So I'd have to go back to the Stutzer paper to see what those two probability distributions are. In derivative pricing, I'll just mention that the two probability distributions are risk neutral and real world. And people will try to find the risk neutral distribution by minimizing relative entropy relative to the real world distribution in a way that's consistent with prices. So, anyway, I mean, I think that a takeaway, if you're not willing to look at the Stutzer paper, is that you end up, working with power utility, if you want to think in utility terms. And so that would make Samuelson happy. So in a way, what Stutzer did is very connected to what we did in that, we're all making Samuelson happy by having investors maximize power of wealth rather than log of wealth. And let's say the way we're doing it, Umberto and I versus Stutzer, is different, but we're all, let's say, using an information theoretic approach. Okay. So like, let's say Umberto and I are using, say, Zala's entropy, which is still information theory. It's just not Shannon's. And, Stutzer's clearly using Kullback-Leibler divergence instead of Shannon entropy, but still it's information theory. Okay.
Very nice. Any other questions coming in? I don't see anything else out there. So, well.
Okay. Let me stop sharing.
Yeah. So, all right. Well, that was really fantastic. Thank you so much. Hopefully, we'll see you back here shortly, so you can join us for dinner. And just for the rest of the audience, guys, this forum sort of the Remo platform kind of self-destructs in 2.5 hours, which means at 8:30 the thing will just suddenly
okay, we can wrap up.
On you. Don't be surprised, but we're gonna end the forum right now with the presentation part. You can go back to tables and discuss further if you like. and I just want to thank Professor Carr. So on behalf of the audience that you can't hear, I'll be the person who's going to have to do the clapping. So.
Wow, definitely. Okay. All right. Okay, thanks everyone.
Okay.
So we'll see you next time, hopefully in person.
Yes,
Okay.
absolutely. Well, thank you so much. We
All right,
learned
bye-bye.
a lot tonight. Cheers. Okay.
Cheers.
How do I end this? Okay, let's stop.